Well, I mean, I'd say I'm relatively optimistic because, the fact is the numbers just say if you're down 10%, odds are on your side that you'll get actually above average returns over the next year. And you'll actually have a gain 76% of the time over the next year. Now, average kind of intra-year declines are about 15%. So could we go down further than we saw on Thursday? Last Thursday, we certainly could. And if we go into recession, it probably gets even worse. But again, I think you have to look at where we are right now. And I also would say, I think he's right on in terms of, I think they really hit these growth stocks a bit too hard. And you've already started to see, obviously, a very strong rally in some of those names.
Yeah, I mean, listen, and we've talked about it on this show a lot about market structure and options and gamma, and I kind of said it wasn't the Fed. There was an article in Bloomberg yesterday that really last month's volatility probably was more to do with options and gamma hedging. We're not bragging. We're simply saying you don't get that kind of violent move because the Fed may pull forward an interest rate hike by one meeting or whatever it may be. What do you think right now, though, Bill, then, is the biggest risk? Is it the Fed? Is it Russia? Is it options? Is it something we haven't even talked about?
I mean, I think it remains the Fed in the sense that, they are in a place they haven't been in quite a while, which is inflation is high enough. They're essentially forced to raise rates, right? I mean, I think everybody says, hey, even if the payroll number's bad on Friday, they're going to raise rates in March. And, market's now pricing in 5 hikes this year. Are they in the place where they are forced to hike enough that they smother the economy? And I think that's part of what's getting priced in here a little bit in terms of some of the volatility. And while I think, again, I'm bullish and I think we'll do fine by the end of the year, I think you better keep your seatbelts on because I think that some of that's going to continue to hang over us for a while.
My guess is you're going to say we should not start pricing in for a recession this year, maybe not early next year. But at some point, do we your clients who are thinking long term have to start slowly adjusting for the idea that this economy is going to slow down and that history suggests that there will be a recession or could be a recession in the next couple of years? And we need to start planning for that because the markets do go down big during recessions.
Yeah, and I think, no doubt, right? I mean, history, we're not going to end recession, so you're going to get one at some point. I don't think you're right. I don't think we're going to get one this year. Clearly, we're going to slow here in the first quarter. But I would say I think that the underlying key is, and part of, I think, is what's going on in the market now, is you've got to upgrade quality so that you're in companies that can make it through the chasm if we do, in fact, or when we do, in fact, eventually go into recession. That also tends to match up quite nicely with what tends to perform quite well when you're in a Fed hiking cycle, probably for good reason because of exactly what I laid out, that's always the fear, right, is that the Fed takes it too far.
Yep.
Or is forced to take it too far.
So with that said, what's our best mix of stock investments right now? Or is it something outside of stocks?
No, I mean, I think stocks give you the best chance to outstrip inflation, which is what you're really trying to do, right? You're trying to keep your purchasing power, better yet, grow it. So I think, at the very moment, I think the growth side looks a little bit more interesting. So, we've been adding to some PayPal, Starbucks. I mentioned those in particular because they actually report earnings tonight. But again, I think you've got PayPal's like over 40% off its high. Starbucks is something like 20% off its high. And again, I think you're talking high quality companies with earnings that, again, will make it through and have some, really great long-term growth opportunities.